The following is an excerpt from one of the videos in my Mastering Covered Call Writing course where we compare the bear call spread to the bear put spread and demonstrate how they are synthetically the same. Enjoy. Now let's compare call and put bear spreads. It's important to understand that a bear spread can be built with either calls or puts. A bear call spread is a credit trade while a bear put spread is a debit trade. The put bear spread has the same sort of profit potential as the call bear spread. And some of you may find this interesting. Let's hop back into the Tastytrade platform here where I have the queues populated. And let's say that I am interested in entering into a bear call spread. I'm in the November 21st, 2025 options expiration cycle, and I'm going to sell the 600 strike call option. And I'm also going to turn around and purchase the 620 strike call option to complete a fairly aggressive bear call spread. We can see that I have negative delta of 18 with this structure, positive theta of just shy of 3, a max profit of $1,154, and a max loss of $845. And when I bring up the profit and loss diagram at expiration, we can see that my max loss is capped at $845 and the max profit is just over $1,150. Now let's take a look at this trade's synthetic equivalent using the put bear spread. So all I'm going to do here is I'm going to populate purchasing the 620 strike put option and selling the 600 strike put option. And this is going to be a synthetic equivalent to the bear call spread. So when I open up the trade detail here, we can see that this provides a negative delta of 22, a positive theta of around 3, a vega of negative 3, a max profit of $1,140, a max loss of $857, and the buying power effect is an $856 debit. And when I bring up the profit and loss diagram at expiration, it is nearly identical to the bear call spread. So here I took a screenshot of the profit and loss diagrams of the two spreads that we just went over, and you can see that they are nearly identical. Max profit on the bear call spread is $1,156 with a max loss of $844. And the max profit on the bear put spread is $1,145 with a max loss of $855. And the discrepancy is because prices were bouncing around as this was taken during market hours. When traders want to express a negative viewpoint on an underlying stock price with bear spreads, they often prefer bear spreads with puts because if the stock drops quickly, thereby making both put options in the money, the bear put spread will normally widen more than the synthetically equivalent call bear spread because as the puts go deeper in the money, they tend to lose more time value. Call bear spreads often do not produce similar results on a quick sell-off. Since the spread involves being short a call with a lower strike price, this call might actually pick up extrinsic value as the stock price falls closer to the lower strike. Therefore, even though the call spread might have a similar profit at expiration, it often will not perform as well on a quick sell-off. Moving back into the Tastytrade platform here, let's populate a bear call spread and compare that to a bear put spread when we're looking at extrinsic value. I am going to sell the 605 strike call option and purchase the 615 strike call option. And conversely, I'm going to buy the 615 strike put option and sell the 605 strike put option to set up synthetic equivalent trades. Now let's take a look at extrinsic value for both the calls and the puts. And we can see here that the short call option has higher extrinsic value relative to the short put option, and we know that in order for vertical spreads to widen and get close to max profit, that extrinsic value needs to decay close to 0. Therefore, the vertical put spread is going to perform better on a quick sell-off relative to the bear call spread. If you found this video interesting or helpful, please like, share, and subscribe, and check out the Mastering Covered Call course if you're interested. Thanks for listening. Have a good one. This video is for educational purposes only and does not constitute investment, financial, or trading advice. No recommendations to buy or sell securities are being made. All examples are hypothetical and for illustration only. All investments carry risk, including the possible loss of principal. Options trading involves significant risk and is not suitable for all investors. Past performance is not indicative of future results. Consult a qualified financial advisor before implementing any strategy and review your financial situation, risk tolerance, cost, fees, and tax implications. Options trading requires broker approval, and not all strategies are permitted in all account types. Returns shown are hypothetical and not guaranteed. Market conditions may change quickly, and results will vary based on market performance, timing, and execution. Read characteristics and risks of standardized options from your broker or at www.optionsclearing.com before trading options.